Welcome to the Tortoise and Hare Financial Podcast, where we bring you the latest insights and strategies for building a successful financial future. Your host Jim Lao is joined by fellow advisor and co-host Genoe. Today's episode is all about the power of perspective. We'll be sharing a story about a blind man who was suddenly given the gift of sight and how he was able to use his new perspective to navigate the world in a completely different way. We'll explore how this concept can be applied to your own financial journey and how adjusting your perspective can help you identify opportunities and navigate challenges with greater success. As financial advisors, we've seen time and time again how a change in perspective can make all the difference when it comes to achieving your financial goals. So sit back, relax, and get ready to see things in a whole new light on this episode of the Tortoise and Hare Financial Podcast.
Powered by Riverside.
Well, I'd like to welcome everybody to the Tortoise and the Hare Financial Podcast. I'm Jim Lao, your host, and joining me today, as always, my co-host and associate advisor, Genoe. Ryan, how are things going today?
It's been a beautiful day, so I'm enjoying some of the weather. Apparently, it's reflecting a little bit on the sun that I'm receiving into, or vitamin D I'm receiving onto my skin too. So, yes, It's been a wonderful day.
Good. Yeah, it's funny. It's been one of those weird ones for me, but I always get excited when we record these podcasts, and I kind of get in a different zone. So I'm looking forward to today's episode, and today we're going to talk about the power of perspective and how seeing things differently can improve your finances. So I think there's going to be a lot of conversation, Ryan, you and me kind of back and forth based on some of our experiences. But I want to start off with an article that we had found through one of the programs that we work with, which kind of prompted this topic today. And hopefully at the end of it all, people are able to kind of recognize that maybe if they view things a little bit differently, things aren't as bad, or they can improve on their finances and their investments and financial plans. So let's start off with the article, and I love reading, so here we go. A matter of perspective. There was once a blind man who was miraculously given his eyesight. Now, for his entire life, he had accomplished everything he needed to do without the benefit of eyesight. Now, instead of utilizing his vision, he leaned heavily on the use of other senses. When he was suddenly able to see, he had nothing to relate his new eyesight to. What was once familiar was now strange and complicated. He was seeing things for the very first time, and he did not know how to travel his daily path by sight. In the beginning, even with his repaired eyesight, he still relied heavily on all of his other senses to guide him. But eventually he was able to use his new perspective to inform his other senses about things he was already familiar with from another angle. He was able to see old things in a new way and was ultimately more informed and better equipped to handle everyday challenges with his new broadened scope of understanding. Now, as an advisor, a lot of what we do revolves around helping people to see things from a different perspective than they have before. Many of the concepts we cover are either brand new or, at the very least, approached from a new direction. Like the blind man adjusting to his newfound eyesight, it can sometimes be difficult to adjust to a new perspective, and that's okay. After all, you don't know what you don't know, and you can't see what you can't see, but that doesn't mean that there aren't things out there that could have a significant impact on your future. So our role is to help you identify threats as well as opportunities and broaden your understanding with added perspective so that you can address financial challenges with more resources than you have ever had before. So, what does that really mean? Bottom line is, I think, in my experience in working in this industry throughout the years, you've come across individuals who have a set mindset on how money works, for example. Mm-hmm. They believe that there is no better way or no other way. And until you inform them of new ways of looking at things, again, from a different angle, from a different perspective. You know, as far as they know, they've been doing everything right
Yeah.
up until that point. And one of the things that I sometimes will ask someone is, if what you thought to be true actually isn't true, when would you want to find out about that?
Yeah.
That make sense?
Yeah,
I think
absolutely.
I think I didn't screw that up. I think I got that
No,
right.
no, I understood it.
Did you?
So yeah, it's
Good.
very true because you're essentially like a horse, right? You're blinded to the information that's kind of put in front of you. Whether it's working with a particular advisor or institution, it goes for all the work that we do. Teachers. I've talked to teachers too that are so used to a certain way of working within a school, and then they change schools, and the leadership principles and stuff open their eyes to something different.
Hmm.
And the same goes within our roles as advisors. You've explained to me how you've worked at a particular institution, uh, only offering a certain particular product or solution for somebody, and then realizing there's a whole world out there. And
Hmm.
really, that quote that you said, you don't know what you don't know,
Right.
really, until somebody presents something different. And with learning and understanding and being very open to know that there isn't one true way when it comes to, especially for us, financial literacy, financial planning, but
Hmm.
there's potentially many different ways based on your situation. And our job as advisors, as coaches, is to kind of guide you and help you open up to different strategies that could help you better in the long run. And I know
Hmm.
we're going to go through some of those things that have been, a huge eye opener, you know, for myself over the last, 5 or 6 years, because, I was taught one way: save, 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 save,
Hmm.
right? Save all this money. And it's what banks do, is they're great at helping you save that money, but what do you do with it? And understanding the difference between saving and investing,
Hmm.
and a lot of things that you've mentioned and we've talked about over the last year or so is there's so many different ways to invest too, and what
Yeah.
what that investment means. And I know we'll talk a little bit about RSPs and you know really the future taxes that you're not aware of or don't anticipate. So yeah, I love this idea of just us continuing to educate people
Hmm.
as to what else is out there for you and your family and your business,
Hmm.
to help make sure that you're the best strategy for saving taxes and future taxes and different strategies of different investments. So
Yeah. One
yeah.
thing I learned a long time ago was learning how to put ourselves in the other person's shoes. And I'm going to use an
Mhm.
example, and one that I learned early on in my career, where I'd have a younger client come to me and say, you need to speak with my mom or my dad or both of them,
Mhm.
because they just refuse to put money in the bank or invest. They keep it all in their mattress, like literally, they keep it
Yep.
in between their mattress.
Yeah.
And they're saying to me how it's wrong, it's not safe, the money's not going to grow. Wonderful. But the one thing that I would ask was, and usually again it's an older person, the person with the money in the mattress, is, did they grow up through the Great Depression, as an
Mhm.
example? And usually the response was, yeah, they grew up during that period of time, very poor. They grew up during World War II, very scary times. And I started to think to myself, I learned a lot about the Great Depression.
Mhm.
I learned a lot about the wars, but I never lived through it. It's very different. And it's very different to speak with someone and tell them, no, you're doing it all wrong now, because today is different in their lifetime, they never would have thought that there would have been a world war, that there would, banks would have failed at the level that they did. There was a third of unemployment rate and people were starving. So sometimes, that person's perspective kind of overrode logic, to be honest with you,
Yeah.
because they lived through, that was their reality at one point. But then there's, other perspectives, which I think you and I still deal with till this day, where we might deal with a client and they'll say, mom and dad have told me that I need to pay down the mortgage as quickly as possible and I have to maximize my RSPs.
Yeah.
And again, my question usually would be, well, did your parents own a home in the late 70s, early 80s? And usually the answer was absolutely.
Mm-hmm.
And I would say, okay, well, let's think about this for a second. If we go back to the 80s and we look at stock markets were averaging about 7% long term, real estate was still averaging 2 or 3% per year. Bank accounts were paying, plus 6% on savings accounts. GICs were paying double-digit returns, but your mortgage payment and your rate was at about 22 to 24%.
Mm-hmm.
So in that scenario, when you look at all your options available to you, it made sense to pay down that mortgage at 22, 24% because you were only getting at best 14 in a GIC with no risk and 7 on average with risk in the markets.
Yeah.
Things have changed. Now we're dealing with, even recently, although interest rates have gone up, we're still, we're at about the average rate of return right now when it comes to interest rates. But long-term equity markets are still performing at well over 7% per year. Long-term real estate, is still 5 to 7% depending on where in Canada.
Mm-hmm.
Short-term savings accounts are now, in the 4 or south of that at this point. And GICs are now in the 4 or 5% and slowly starting to go down again.
Yeah.
So in today's environment, it doesn't necessarily make sense to pay down your mortgage aggressively because you can do better with your money if you have it somewhere else.
Yeah.
And we're going to show a bit of an example of that on how that looks as opposed to using your own money, for example, to pay down debt or have it invested or to self-finance. So there will be some examples that we're going to talk about. Mm-hmm. Now, we deal with some financial blind spots. Many Canadians do. The first one, and I think this is more something that you're more familiar with because you are someone who has helped many people with budgeting. You budget yourself. Yeah. But not really, being aware of where someone spends their money. And it's amazing when I work on a cash flow process with a client where they're shocked with where some of their money has gone. And I have a personal example with me being a techie guy and the iPad first came out.
Yeah.
At the time, I believe it was like $700 to get the first iPad. And I was trying to find a way or justify, me purchasing that iPad. Now, at the time, every day in the town that I lived, I would go down to the local coffee shop and I'd get myself my medium double-double. And I would get my Toronto Sun newspaper. And usually it was about, I think, like $2.50 or $3 a day because of where I was situated. So we were outside the GTA, so you had to pay more for the newspaper. And then, of course, it cost about $2.50, I believe, on a Saturday and a Sunday. And to me, that was just pocket change. It was literally change in my coffee cup holder in my car. Mm-hmm. And I would just collect it and go ahead and get my coffee and buy my newspaper. But then, because of this little project that I was on, I decided to add up how much is that actually costing me throughout the year. Never in my mind had I thought about that. Again, for me, it was pocket change on a daily basis. Well, it was about $680 a year is what I was actually spending on a newspaper that I mostly read the sports section of and then would throw away, and a medium double-double. And that was about what I needed for the first iPad. Yeah. So then I thought to myself, if I stop using my pocket change and I make my coffee at home at 15 cents per cup, and I don't go out to get the newspaper, and I can read all of the newspapers online. That was a way for me to kind of find that 700 or that $680 or $700 that I needed.
Yeah.
And it's amazing how many times I sit down with a client and we go through a cash flow project. I had one client years ago who, when we ran their budget, they were spending $1,000 a month at the LCBO.
Mm.
And they knew they were spending a lot of money at the LCBO. They just didn't quite understand how much. And again, that was a bit of an eye opener. And when it comes to budgeting, I'm not someone who says, don't do this or do that. It's just more of go through the exercise. You'll see it for yourself. You'll know where the issues are, and then you can learn to adjust. So anything to add to that?
I highly recommend anybody to take the time to go through their budget and spending and understand where the money is flowing, right? And if you want the money to flow towards a longer term goal, or whether it's retirement, house, car, whatever it is, you can very easily change your mindset to make sure that the money is flowing towards those areas that are most important to you. And it's surprisingly how quickly it will get away from you. I've got my golf shirt on. I'm ready for the golf summer season right now. But how quickly money will start flowing in other ways, especially as the summer comes upon us. And just asking yourself, and again, that's part of having somebody like us, is just to be a coach, be that extra person to bounce. Where am I in regards to my goals, and how can I ensure that I get there a little bit faster? And again, you said our job is not to police your money. Our job is to, whether you need it or not, to help you be accountable for it. But ultimately, our goal is to help you reach your goal, right? Whatever the financial is, because the financial goal is freedom to do other things, right? So, I often spend that time helping people go through their spending habits and have them have a real eye opener as to where money is going. You run into people that are endlessly in debt because of their credit card, or they're double paying for Netflix or whatever app they're not using that they realize that
That's a big one. Yeah, I did an episode last year, and I talked about that, in terms of how a lot of the offerings that we have now all pay for service or pay for use service, and there's a monthly subscription to it, and it's amazing how it can add up, and you might not be using a lot of them, and yet you're paying X amount, and then when you calculate how much that is per year, and you attach the lost opportunity cost on top of that, it's a big number. So that's one thing I personally do every year, usually around like between Christmas and New Year's. I go through an audit, and I audit my accounts, and I look to see, okay, well, what's coming out of my account, what's this for, and is it something that I keep using? And if it's something I used once in 12 months, like, done, we're not going to use it, we cancel it. But what I am finding too is a lot of companies are making it that much more difficult to cancel your subscription as well.
That's what they're hoping, right?
Yeah,
they're hoping you're not going to cancel the subscription to whatever it is, and you're going to keep paying, right? And it all adds up. But I guess it really comes down to, we no longer, as we date ourselves, we no longer carry around that little booklet that you go into the bank and they print out all your expenditures and where the money's gone. And we do, and to do it, 3 or 4 times a year or once a year, just to make sure that there's no charges that don't belong there, right? And many clients have gone through after doing the exercise, and there's a $1,200 charge that they're like, where did this? And they've paid off the bill, not realizing there's a $1,200 charge for something that was a fraudulent charge from an Amazon account, or whatever it is. And
why isn't it never a $1,200 deposit?
I know, like, exactly right.
It's always a $1,200 charge. Like, what about the deposits? We need to see a $1,200 deposit in there, and then you might not question it, right?
And you go over it, and it's funny because you talk to people of like something that you bought and you weren't sure, and you didn't really like it, and then you forget to return it, and it's $50 here or $100 here, and
it adds up.
Here's these subscriptions, and before you know it, we've uncovered probably $2,000 or $3,000 that by the end of the year that could be going towards something else, one of your goals, right? Your retirement or your new television, whatever it is that you decide. My goal is trying to do my backyard, right? Trying to make it a nice escape for myself. So
well, going back to the whole retirement thing, the retirement goals, I mean, that's another big blind spot that a lot of people have is they really don't know how much they need in retirement. They don't know how much they need to save to reach that goal. They don't know what their rate of return needs to be to achieve that goal. And they don't know, again, what their potential standard of living is going to be like in retirement. So that's another blind spot that most clients have, where we help them go through that process. It's literally, let's talk about your standard of living. Let's focus on what do we need to maintain that standard of living when you are retired. And then kind of, reverse engineer it, where it's how are we going to get to that point? How are we going to do this? And walk everyone through it. And some people, they're amazed that it's really not that difficult to achieve their goals. Others, it's almost impossible because they've waited too long. But that is definitely another gap or blind spot we have to deal with. I want to kind of go through another example on seeing things differently. And for those of you who are listening, there is a visual that I'm going to be showing now, but I will clip this part, and the link for this clip will be in the podcast description. And for everyone else, we're going to talk about, how do you want to pay for it? Do you want to self-finance your purchases, or do you want to use your bank's money to finance your purchases? And this is an example that I personally went through last year. Even though I've been helping clients through this process for over 20 years, it just goes to show, as humans, we react a certain way. We're conditioned a certain way. And, I'm fortunate that I can kind of pause, put on the advisor hat on. I have the tools to kind of work myself through these situations. And it's what I do with everybody else. And so does Ryan. So I'm going to share my screen here. This is the first time in the Tortoise and the Hare Financial Podcast history that we're actually going to do a live visual. And let's hope it all works.
It's funny you mentioned the water heater example that you're about to, because we did this for myself too. Like you did it, I guess it was almost 2 years ago that you had the water heater problem. And then I was talking about the water heater myself back in, I guess, September.
It was last year that it happened.
Yeah, August, September.
Yours a few months after me.
Yeah, exact same thing. And we went through this. It's reminding ourselves to do these little things, to say.
Yeah. So let me set this up for everyone. So it was long weekend of last year when we had the major storm. Tore through our place, lost power. After power came on, realized that our hot water tank blew up. Now, my house is 20 years old. My house is actually heated by hot water, so it's a radiant heating. And because it was also 20 years ago, everything's out of code. So in order to find the right hot water tank, I use one of those instant water heaters. And then having to rerun all the piping. Copper last year was expensive because of supply chain issues. My bill was about $10,000 plus HST, so it was $11,300. So right away, I thought to myself, I'm going to pull the money out of my tax-free savings account to pay off the $11,300 bill. And then I thought, maybe I should find out if there's some financing options. So, of course, I asked the question, and they said, absolutely, we would love to offer you financing. You can amortize this over 15 years, and it's 10% per year for the next 15 years. And I thought, whoa. That just doesn't make sense to me. Like, why would I pay 10% in interest cost over 15 years? That's crazy. But then I remembered this is what I put my clients through every single time these situations come up. So I walked myself through this same process. So I'm going to use this calculator. And the first thing we're going to do here is I'm going to change the time frame. So we're going to move it to 15 years. And in terms of the amount that I would borrow, 11,300, and I'm putting in at 10%. And my monthly payment's about $120 a month. So you can see it here as well. My total interest cost, if I did this over 15 years, was $10,557. So basically double. I would have doubled my cost for this hot water tank if I tacked on the interest expense. And again, right away, most people would look at this, as I did myself personally, and say, why would I pay $10,000 in interest costs? I'll just take the money out of my TFSA account. But then what we do, and again, this is the benefit of having these tools, is I looked at, well, if I left my $11,300 in my tax-free savings account, and I'm averaging over 15 years about 7% per year, well, my 11,300 would grow to a value of about $32,193. So I would have actually made close to $21,000 over the same 15-year period. So if you look at this example, it's actually costing me more if I took money out of my TFSA, because I would have missed out on making $21,000, instead of financing it over the 15-year period where it would only cost me 10. So basically I'm $10,000 better off if I just take out the loan and I pay the 10% and keep my money where it is. So then you start looking at, well, what if I'm only earning 5% on my money? Still up $12,585. So I'm still up by a couple of $1,000, let's say. So I think the break even in this scenario is about 4.5%. Oh, that didn't work. 4.5. We're not making any payments to that. Yeah, so about if I'm earning at minimum 4.5% on my money over the next 15 years, I break even in either scenario. And then people will say, well, why is that? Because that's more than half of the cost to borrow. And it's because of compounding, the compounding effect. Mm-hmm. We're now compounding at 11,300 over that 15-year period of time. So in looking at this as an example, I'm just going to stop sharing here for a second. In looking at that as an example, in looking at things from a different point of view, I would say that if I sat down with a client who presented me with this case, 99% of them, if not more, would have said, I'm just going to pay it off, take the money out of my account because I don't want to pay $10,000 in costs, because they never would have considered the lost opportunity in that decision on the money that they actually have had invested.
Yeah.
And we run people through this example. I mean, I've had people over the years come to me and looking to buy vehicles. Family car breaks down, need a vehicle, $50,000. And I'll ask the question: can they support whatever the payment is? Usually, the answer was yes. And then we run the numbers, and again, we can see that it's still better off just financing the vehicle than to take your own money out. And if there is a shortfall in any given month, you can tap into your account if you have to make up that shortfall. But if you take $50,000 out of your TFSA, as an example, to buy a vehicle, you drive it off the lot, you've already guaranteed yourself a 30% loss on your money, right there, right off the bat. Mm-hmm. So you've guaranteed yourself a 30% loss because of the depreciation, and then 6 months from now, you lose your job. Something happens from a cash flow point of view, you need roof replacing. You can't go back to the car financing company and ask for some of that money back. Mm-hmm. You just can't. But if you have it liquid and available and accessible, so even though you're making payments on that car loan, as an example, and something happens, first of all, you're not going to lose 30% on your TFSA unless you've invested in Bitcoin and something crazy like that. So that is possible depending on how you've invested your funds. But you have liquidity, you have access to those funds if you need to.
Yeah.
Most people don't see it that way. But when I illustrate this example, then there is an aha moment that tends to happen.
Yeah. And there's a very much an old school mentality of this, of just paying it off, right? That's often
Don't
the
carry
first
debt.
thing.
Yeah. Don't carry debt.
Yeah.
Not
And
realizing
exactly
that
it.
you finance everything that you buy cash,
Yeah. Yeah.
right? It's just a different form of financing.
Yeah. Um, yeah.
So, right, I know you put in here mortgages paid off, missed opportunities, liquidity. You want to expand on that?
Yeah. Often, as we mentioned earlier, people are jumping the gun to pay off their mortgages sooner. And, you know, we're no longer dealing with, the late 70s, early 80s with the high interest on mortgages, right? We're even to today, people think, oh, the mortgages are so high, the interest rates, but they're not high in comparison to what we've seen over the last 40 or 50 years.
Yeah.
And how this exact same program of asking, whether I should pay my mortgage off faster, leaves you a little bit less liquid for other opportunities that could perhaps come up along the way, and how you could gain on an investment opportunity down the road. Again, I have many clients that are so focused on paying their mortgage, but they're potentially missing out on, maybe leveraging the chance of buying another property, having that extra cash flow to help with the down payment. Obviously, there's other strategies that people can use. Obviously, being able to sit down with somebody in their individual situation, but yeah, something happens and you can't easily access the money that's already in your house, versus something that is there and ready for you, that's in a TFSA, or a non-registered, or cash, or high interest savings somewhere, right? So
Yeah, and working with high net worth clients, the one thing they really value is having use and control of their own money,
yeah,
having access to capital. Because if it is tied up,
yeah,
you potentially miss out on an opportunity.
yeah, yeah.
So that's very important. And when you pay down your mortgage, that's what you're doing. You're giving up control of that money.
Yeah,
You're giving it back to the bank.
yeah,
And if you ever need it back, it becomes very costly
yeah,
to have to go finance and to qualify for it. And not only that, in addition to that, you're relying on one asset to grow in value. And absolutely, real estate is, again, probably the asset that most Canadians, or a lot of Canadians, have most of their wealth tied into.
yeah,
But why not have your investments in multiple assets?
mm-hmm.
The multiplying effect. We don't want to accumulate. We want to multiply our wealth.
Yeah,
So, to have funds invested elsewhere, and we're not talking about take the money out and buy a boat with it, or take the money out and go on vacation. Like, being responsible, investing it, having access to it in the event of an emergency. And I guess the other thing we should say, with the current interest rate environment, it's also dependent on, what the renewal looks like,
mm-hmm.
and what the bank requires for you to renew your mortgage or to finance through a new lender. They might need some of that money to be paid down, but at least you have access to it, and you can make that decision with it at the time of the renewal, as opposed to just having it all paid down on your mortgage.
Well, you're making a great point too with mortgage payments. The number of clients that were over contributing to their mortgage when the rates were really nice, and now flash forward 2 or 3 years, and the interest rates have, in their opinion, like doubled,
Mm.
right? They no longer have access to that money, cash,
Yeah.
that they're now struggling to pay their monthly mortgage.
Yeah.
Had we gone through a project like this and ask the question, they would have that money strategically.
Strategically?
Thank you.
You're welcome.
Set aside for themselves for the times like these where they're like, okay, now I'm up against the wall as to what my mortgage payments are. And for those people who listen to the strategies and think outside what they've always been told, those people are sleeping easier at night right now because they have that extra cash flow that they made sure that they kept to the side instead of rushing to pay off their mortgage. So
and that's a difficult one for a lot of people, again, who have been told they should accelerate their payments, make prepayments. Sometimes we'll deal with a young couple. Our partner John, who's a mortgage broker, will ask the question when they insist on a 25-year amortization and doubling their payments or whatever, and he's like, what does your next 5 years look like?
Yeah.
And they're like, well, we don't know. And he's like, okay, well, they got married. Are you planning on having a family? Yeah, probably in the next 2 or 3 years. Okay, so that means maybe half the income for a year, even if each of you decide to take some time off of work. Yeah, probably. How's that going to impact you making your mortgage payment? Well, that's going to be a problem. Well, maybe you don't want a 25-year amortization. Maybe you want to consider a longer amortization period, but still pay it down as a 25-year, knowing that you can kind of scale back a little bit during the period where you might have a lower family income. Or how about you still pay it at the 30-year pace, and the top up, put that aside in an investment account, and you can have access to it. So these are things that people don't think about, they don't foresee. And it's the benefit of working with advisors who not only have the knowledge, the experience. We've personally have gone through a lot of these scenarios. Again, going back to the hot water tank situation, we're going through these situations ourselves as well, and walking ourselves through, what is the best decision based on the current circumstances.
Yeah.
Right. Now, the next one that people really have a hard time adjusting to, and you put this down as well, which is a good point, is the RSP contributions.
Yeah.
Right. Now, the first thing we will say is we're not suggesting that people should not be making an RSP contribution. I think I know what we're saying is it's not really the only option, and it might not always be the best option in preparing for your retirement.
Yeah.
Ryan, did you want to go through a couple of examples as to why it might not be the best idea for everyone?
Yeah, well, again, a biggest portion is that we've pushed this idea of certain institutions like RSP, 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 and that's what the government wants us to do to save for future retirement. But what we don't often realize or think about is what does the future tax look like for ourselves, right? And that's where we often get into some kind of sticky situations. And we're both of us are working on a lot of clients right now that are in that situation where they've contributed to the RSPs for so many years that their outcome now is that they're going to be facing more taxes in retirement than they are in their current situation. And the people that I often see in these situations are especially people that have pension holders. So the nurses, firefighters, police, teachers. Those are the ones that I see that are facing retirement in something where they've, like, oh, I'm okay, I'm getting my pension, things like that. But often they don't realize they're setting themselves up for some higher tax brackets that they probably didn't anticipate, which then leaves them a little bit less fluid to, travel the way they wanted, spending time with, family and buying that cottage or whatever it is. So, again, this is why, working with people like ourselves of how can we see your future and how it unravels, and making sure that we see some of those threats or opportunities that you may not have seen before. And it's, it's a real eye opener for every client that I've done this with. It is a true eye opener of where they they're so focused on getting their tax return now that it's costing them in their retirement.
It's immediate gratification.
Yeah.
It's the immediate gratification. There's this misunderstanding that they're saving in tax,
Yeah.
not realizing that they're just kicking the problem down the road. And it's going to be, in many cases, a bigger problem, not just in retirement, but, we do walk through our clients and we illustrate, here's what your tax bracket is during your working years.
Yeah.
And hey, look at what your tax bracket is going to be based on your retirement years. And it's a lot of times it's higher than during their working years. To your point, usually it's someone who has a very strong defined benefit pension plan.
Yeah.
It's typically a government employee who has that. And they're still maximizing their RSPs because their banker's telling them that they should, without really walking them through the plan and walking through what that really means from a tax problem. And, I've had clients who still insisted on contributing to RSPs approaching age 71. And they're like, I don't want to take any income from my RSP because I'm already at a high tax bracket. It's like, sorry, government makes the rules.
Yeah.
And
that's another one.
This is what the rules are.
Yeah. People don't realize too, the government establishes the rules of how the RSP is going to come, or I guess it's no longer an RSP. It's a RIF, but how those are going to come back to you.
Yeah.
And even, again, as we work through some of the things that we're doing now for strategy for clients, what does the estate look like at the very end, right? And
we're seeing a lot of that now.
That is just, and this is some of the largest generation that we're going to see that is passing on large amounts of wealth, but it's being taxed at its highest amount. We still do, again, for some people that are in maybe the 40s, like myself, you don't know what the tax rate's going to be in 20 years when you retire, right? So, and the same goes for when ultimately, you're no longer dancing on this planet, but what does that look like for your family? Did you want to leave an estate? Did you want to leave a legacy for, your kids, your grandchildren, further generations, maybe perhaps passing it on to a charity, and what that looks like. And, we go through that with people of really showing a roadmap as to what the future holds for that. Obviously, we're taking what it is right now. I fortunately don't have a crystal ball, just one of those magic 8 balls that you shake and it says try again later. So, but yeah, we don't know what the future holds, but we know that it's very rare that the government lowers taxes. Very, very rare.
That hasn't been the trend. The trend has been in the opposite direction. And going back to the estate discussion, we had a program we used before, a planning program that maybe didn't do a very good job of kind of highlighting what the tax bill is going to be when a person passes away. And now I have clients who we set up on our new program, and they're emailing or calling me saying, why are these registered accounts showing like a 50% loss? And it's like, that's not a loss. That's the tax bill when you pass away. Yeah. And they're shocked by it. They really are.
Yeah. You work all this time, and you're immediately going to give probably about 60% of your wealth to the government right away.
And I've had clients who we've had the conversation with throughout the years, and they didn't really act on the recommendation until, the second parent passed away. Yeah. And, they thought they were getting $300,000 from the RIF, and they realized I'm only getting half. Yeah. And then they're calling me saying, I don't want to do this to my kids. What do we got to do to kind of change this? Yeah. And we do have strategies that we can talk about at some point on how we could potentially draw from those RSPs in a tax preferred way. But yeah, it's the reality. It's that, as a good friend of ours, Jay at Raintree Wealth Management says, it's that punch in the face event.
Yeah.
Right? You get punched in the face, and it's like, whoa, now you need to react differently. And so that is a big one. And it's very difficult for a client who has been making their RSP contribution, they're making their deadline contribution every year, and they know that in a couple of months they're going to get a refund back. It's very difficult to change that habit, even though we're showing them 20, 30 years what that's going to cause in terms of financial problems, or tax problems primarily.
Yeah.
It's still, there's still, it's difficult to kind of break that. It is a habit. It really is.
Yeah. And if you have the long term in mind, and your family and your children, and however you want your legacy to be left, today is the best day to start. Obviously, 20 years ago would be the best day to start, but today is the best day to take that step and talk to somebody like us and just find out what it is. It really it costs you your time just to take an hour to talk with us about what it is that you want as your ultimate end goal for how you build your wealth. So,
True. So I think it's probably time to wrap it up with a 45-minute mark here. Any final thoughts, comments, Ryan, that you'd like to make?
Work with a coach, an advisor, whatever it is. Obviously, call us is the best option, but just know that there's a lot more than what you're kind of blinded to, and what the media tells you, or what your local bank institution tells you. We can really have a great conversation about what is best for you in the end. And we're here to help and educate people on. That's why we host the podcast, right? So
and in terms of educating people, just as a reminder, you can find us at tvhfinancial.ca. There are some resources there for anyone who's interested. They're free resources. In addition to that, we also have the TVH Financial mobile app. There's some calculators there. Again, you can listen to our podcast through there. Lots of articles that are sent out through the app as well. So I encourage people to download our app. If you like, and you feel that there's some family or friends that might benefit from listening to some of these episodes, we'd encourage everyone to share and like and post and repost and all those other wonderful things that people do on social media. And finally, if you'd like to speak with us, you can call us directly, 647-727-4668, or you can email us financial@tvhgroup.ca. I think I'm done for the day, Ryan. I have nothing else to say myself, so we will sign off. I'd like to thank everyone for watching and listening, and please look out for our next episode. Thanks again, Ryan, for joining. We'll talk to you soon.
Thank you.
All right,
Take care.
Bye.